Critical Man Pictures presents the Forex video training series. Black Belt, First Degree, Introduction to Market Sentiment. Every trader will always have an opinion about the market. It's a bear market. Everything's going to hell. Things are looking bright. I'm pretty bullish on the market right now. Each and every trader will have their own personal explanation as to why the market is moving a certain way. When trading, traders express this view in whatever trade they take. But sometimes, no matter how convinced the trader is that the markets will move in a particular direction, and no matter how pretty all the trend lines end up, the trader may still end up losing. A trader must realize that the overall market is a combination of all views, ideas, and opinions of all the participants in the market. That's right, everyone. This combined feeling that the market participants have is what we call market sentiment. It is the dominating emotion or idea that the majority of the market feels best explains the current direction of the market. As a trader, it is your job to gauge what the market is feeling. Are the indicators pointing towards bullish conditions? Are traders bearish on the economy? We can't tell the market what we think it should do. What we can do is react in response to what's happening in the markets. Note that using market sentiment approach doesn't give a precise entry and exit point for each trade, but don't despair. Having a sentiment-based approach can help you decide whether you should go with the flow or not. Of course, you can always combine market sentiment analysis with technical and fundamental analysis to come up with better trade ideas. In stocks and options, traders can look at volume traded as an indicator of sentiment. If a stock price has been rising, but volume is declining, it may signal that the market is overbought. Or if a declining stock suddenly reversed on high volume, it means the sentiment may have changed from bearish to bullish. Unfortunately, since the foreign market exchange is traded over the counter, it doesn't have a centralized market. That means that the volume of each traded currency cannot be easily measured. Without any tools to measure volume, how can a trader measure market sentiment? This is where the commitment of traders comes in. The COT report. The Commodity Futures Trading Commission, or CFTC, publishes the Commitment of Traders report, COT, every Friday around 14:30 Eastern Standard Time, U.S. Because the COT measures the net long and short positions taken by speculative traders and commercial traders, it is a great resource to gauge how heavily these market players are positioned in the market. Later on, we'll let you meet these market players. These are the hedgers, large speculators, and retail traders. Just like players in a team sport, each group has its own unique characteristics and roles. By watching the behavior of these players, you'll be able to foresee incoming changes in market sentiment. You're probably asking yourself, why in the fuck do I need to use data from FX futures market? Doesn't the spot FX market have a report that measures how currency traders are positioned? I'm a spot FX trader. Activities in the futures market doesn't involve me. Well, remember, since spot FX is traded over the counter, transactions do not pass through a centralized exchange like the Chicago Mercantile Exchange. So what's the closest thing we can get our hands on to see the state of the market and how the big players are moving their money? Yep, you got it. The Commitment of Traders report from the futures market. Before going into using the Commitment of Traders report in your trading strategy, you have to first know where to go to get the COT report and how to read it. Open up your browser and point it to the following address. Once the page is loaded, scroll down a couple of pages to the Current Legacy Report and click on Short Format under Futures Only on the Chicago Mercantile Exchange row to access the most recent COT report. It may seem a little intimidating at first because it looks like a big, giant gobbled glob of text. With a little bit of effort, you can find exactly what you're looking for. Press Ctrl F to find the particular item you're looking for, say pound sterling, and you'll be taken directly to a section that looks something like this. Yowza. What the fuck is this? Don't worry, we'll explain each category below. Commercial. These are the big businesses that use currency futures to hedge and protect themselves from too much exchange rate fluctuation. Non-commercial. This is a mixture of individual traders, hedge fund, and financial institutions. For the most part, these are traders looking to trade for speculative gains. In other words, these are traders just like you who are in it for the Benjamins. Long. It's the number of long contracts reported to the CFTC. Short. That's the number of short contracts reported to the CFTC. Open interest. This column represents the number of contracts out there that have not been exercised or delivered. Number of traders. This is the total number of traders who are required to report positions to the CFTC. Reportable positions. This is the number of options and futures positions that are required to be reported according to CFTC regulations. Non-reportable positions. Open interest positions of traders that do not meet the reportable requirements of CFTC, like retail traders. If you want to access all available historical data, you can view it here. You can see a lot of things in the report, but you don't have to memorize it all. As a budding trader, you will only be focusing on answering the basic question, what is the market feeling this week?